Good morning and welcome to our weekly broadcast every Thursday morning at 10 a.m. I'm your host this morning. My name is Dal John. I'm the Investor Portfolio Manager for Leo Crowdfunding. Today we have as our special guest David Johnstone. Hello David, how does it feel being in the hot seat today?
It's always a little bit different when you're not hosting, but looking forward to today.
Indeed, and we've also got John Corey from Property Fortress. Hello, John. How are you doing?
Good day, Del. How are you?
Very well. In the US, I understand. What's it, 5 in the morning there?
Well, it is because I'm on the East Coast. I can't wait till I move to Hawaii, and then it'll be like 10, 11 hours, 12 hours difference.
Wow, indeed. So just wanted to run through some housekeeping. These sessions of broadcast is recorded, and it's available on our YouTube channel. I have already put a link in the chat. Please do subscribe. That'd be much appreciated. We'll be looking at various topics today. So overview of markets, and John will be going through educational tips, and we'll be focusing on our projects, current projects and new projects as well. Also, I wanted to mention this is no way deemed to be advice. It's for information purposes only. We are appointed by our principal sharing, who is authorised and regulated by the FCA. So we do have a duty of care to our investors and fundraisers. So if we kick off, also, if I can just mention any questions, feel free to put them through our Q&A. So that we can go through those questions throughout the broadcast. That'd be great. So just to highlight property markets. So we're going to be doing a brief overview. So today's article is around UK house prices reach a new record. Cost of living crisis threatens growth. So UK house prices reached a record high in January, according to Halifax, but the lenders have warned growth is likely to slow down considerably this year due to finance and just increase expenditure. So those of you who may not know or know already, last week the energy suppliers have mentioned that they'd be looking to increase energy supplies anything between kind of 40 to 50%, which will take effect in April. Over to you, John.
Well, you know, there's this funny thing. It's like, what if house prices just stayed flat for a year? Is it really going to hurt anyone? Other than people speculating on short-term rises, I don't think it matters that much. I know my property investor friends are going to be unhappy when they hear I said that, but this idea of it doesn't have to rise every year, it doesn't have to rise every month, it could go up, it could go down a little, whatever. So if you're a landlord, it's about the cash flow. It's not about the buildings you own appreciating all the time. And most people are in property for like a decade as an investment. If you're a homeowner, it used to be 7 years. I don't know whether it's longer or shorter between moves, driven by family events. So if house prices stalled, even during the housing crises, people say, oh, house prices fell. Well, it only fell for those that sold. Something like less than 10% of the market sold during the crisis. The rest of us continue to use our buildings. We get up in the morning, we washed our face, we made breakfast or whatever. These days we work from the house, you know, that sort of thing. So people need to get a little bit of perspective on this, that a house has utility value and also has economic value, and they're not the same and they're not correlated. So great headlines, fun reading, wonderful topic of discussion next time you go to a dinner party. But at the same time, don't get so freaked out about these things. Affordability is an issue. That's a bigger problem. And that's a bigger problem for those who want to buy, rent, whatever. It doesn't even necessarily have to be just the people buying, even just renters. And right now, there's a lot of movement in the market. A lot of people want bigger places. They want to be out of the city. They want to be in the country with space, or maybe they want to go back in the city. So we're seeing a lot of change, and therefore we're seeing a lot of turbulence in the pricing when it comes to the rental, the monthly amount. These articles, though, they're mostly clickbait.
Yeah. Yeah, totally. Thank you, John. Totally take that on board, and I think it's always nice to have an overview of kind of where we sit with these articles in some cases. So we do have or ask John frequently questions every week, just to kind of highlight typical questions that have come up through our investors and even fundraisers as well, from an education point. So, John, we will be going through various questions that have come across to us from our investor base. Obviously, I deal with the investor side, and these are kind of the normal questions that have, or key questions that have come across, which
I'm told we have two changes this week. One is we're going to have more than one question, and two, we're even going to let David have a view. Yes,
indeed. So we definitely got David on as a guest to pick his brains and get his view across. So yeah, look forward to kind of hearing from both of you.
Yeah, I think Dal is going to be a really good section, because we're going to like rapid fire through a number of questions that I think mainly you've been asked a lot from people you've spoken to, you know, on phone calls and in email exchanges. So yes. You know, this is going to be good. We're going to skim through for the high level bullet point brief answers across a whole range of questions around our various topics. So yeah, over to you, and we'll fire away.
So yeah, first question, just around kind of equity itself. So equity investors buy shares in special purpose vehicles. At the end of the project, the shares are brought back by the SPV. So just to want to highlight, what is an SPV and why are they used?
So SPV, special purpose vehicle, means essentially just a limited company. If you're England, Wales, it'd be at the normal company's house type site. If you're Scotland, it'd be whatever registration Scotland uses for companies. It really is a single purpose. So I'm going to buy something, I'm going to do something with it when it comes to this property, and that business inside of that company, that's all it's going to do. It might have a limited duration. A couple things. One is they're used classically to help ring fence the project that the companies form, the projects worked on and completed, and then the company is actually dissolved. That limits liability. It also makes it easier for the lender to understand what the liability is when they're going to actually put a loan in place. Now, when it comes to equity investing, you can't buy shares unless you have a company to issue shares. So you do need to have a company. You can't issue shares in a building. So that it has a dual purpose. One is it's classically used for development or project-based finance, and it's also used for the ability to raise equity by selling shares to individuals through the platform.
Just to add to that, for clarity, LLPs are not able to be used for equity investing. So I know I've been asked that in the past. So LLPs are not able, because they don't issue shares in the way an SPV does.
Yeah, it's a good point, David. LLP, limited liability partnership, is the clue there.
Indeed. So another question. So what happens to my shares when the project has ended?
So that is technically up to the project and whatever was agreed with the shareholders. So read your shareholder agreement before buying shares. There'll be conditions set out. There'll be details set out, whether the shares will be bought back, whether the shares will be retained, are there dividends, what's the priority of the shares. There's a lot of detail about your rights and your responsibilities and how you might benefit. So it should all be in the shareholder agreement, and there'll even be a process to cover things that weren't anticipated. There's no automatic buyback. It might be tradition or it might be common, but read your shareholder agreement.
Thank you, Dave, John. As a shareholder, what say do I have in running the SPV or project?
Well, there's sort of three angles in this. First of all, read your shareholder agreement. It'll tell you. Second is, if you're a smaller passive investor, then probably the assumption is you're going to be small and passive. If you're new to whatever is going on, then possibly you wouldn't have a lot of experience to bring to bear. So you might have zero voting rights. You might have zero say. You might be along for the ride, similar to, I like to say, a bus analogy. There's a bus driver that drives the bus, and I sit in the back, and I largely don't get involved in telling the driver how to drive the bus. Also, if I was a shareholder in a project, I wouldn't want necessarily someone else taking over that project. Many times buying shares in an SPV because I trust or feel that the people running the project have the expertise, the knowledge, the ability to get on with it. And I don't want my other fellow shareholders messing about with the control and the direction of the project. I didn't get to vet them. I didn't get to check them out. I don't know who they are. Why should they have a disproportionate say in what effectively is my future success?
Yeah, and what is very, very important, as John said there, is that investors should read, must read, encouraged to read the shareholder agreement. That is the legal basis of the relationship between the investor and the fundraiser, and therefore that shareholder agreement, if it's a good one, will cover all the eventualities that can happen in the process, and explain, what part you as a shareholder have. So drag along, tag along rights, all those good things that happen in these type of businesses should all be explained and laid out. Traditionally, passive shareholders don't have a say, don't have a vote. The principal, the fundraiser gets on with running the business. Crowdfunding shareholders are passive investors, but everything's laid out in the shareholder agreement. So definitely read the shareholder agreement.
I have a quick compliment to what David just said. If this is all new to you, think about putting in the absolute minimum amount that you can afford. You might lose all your money, so be careful. But if it's £100 and that gets you access to the shareholder agreement, and you get to read it and you get to understand it, and you invest in 5 projects for £500, that's probably less than a class. And then you'll have 5 different shareholder agreements. You'll get to see what happens and what the document said and all the rest of it. So an interesting way to learn is to actually do this. And the FCA has this principle that after you've invested in a few deals, you become sophisticated because you're reading the documents, you're a part of the process, you're seeing it from the inside. You may decide this is not for me, I don't like this going forward. That's perfectly fine. But if you want to read all these documents, you want to be part of the process and learn, possibly you need to be on the pitch.
Yeah, thank you. Yeah, absolutely agree with that, John. So another question, so development type projects. So we'll just go through a couple of strategic projects that we have on the platform, or typical projects that we're looking at. So normally these are ground up or involved major refurbishment projects. So the first question there, just wanted to highlight, what do you look at in a vanilla development project? So what do they look like?
So I don't know that there is such a thing as vanilla. How could the queen go and lose a king? And he was buried under a car park. That's not very vanilla. But classically, building is a very old profession, one of the oldest professions. The idea that people are going to construct something and that they're going to finish, and that at the end they'll turn over the keys or whatever the ceremony is, and then they'll move on to something else. So I tend to look, if I'm an investor, I look at the track record of the people involved. It doesn't bother me if this is something slightly new, because everybody maybe wants to learn, but okay, if they're going to learn something new, do they have other people on their team that have experience? Is it a stepping stone from their last project? Or if this is exactly like the last project, how did that one go? How did the one before that go? One of the interesting things one party told me once is every project has surprises. It's just how fast they come in and how well you handle them. These things are not extremely predictable. The weather can be a factor. Border crossings could be a factor when it comes to supplies, materials. So vanilla to me is just something where it seems like a reasonable amount of time. They seem to know what they're doing. They have planning permission. They have the right checks and balances, as far as I can tell. I might talk to other people, get their views. And then from that, I form a view whether it's worth putting money into.
Thank you, John. And one of these questions here, so this comes up often than not. If the project goes wrong, where does my investment rank?
General principle, all debt ranks ahead of the equity. So any loans, secured or unsecured, will be addressed before the equity shareholders receive anything. If there's not enough money to go around, the equity shareholders bear the brunt. After that, it's down to what the shareholder agreement says. So the different equity, there may be layers of equity, there may be prioritization about who's going to get paid first, or if there's a minimum hurdle before certain people get paid out. So what you'll classically see is some detail about that in the shareholder agreement, and that should tell you you're expecting the lion's share of the profits. The lenders don't get a share of profits in most cases. So therefore, if you're going to get more of the profit, then you probably are taking more of the risk, and that's why you're the equity.
Yeah, that's exactly the point I was going to make, John. Just to highlight that you know, the return on investment being offered will be a pretty good indicator as to where you rank when it comes to the project going wrong. And as you say, you know, this is property investment. A lot of property developments do go wrong or are delayed. So people have to be aware when they go into this type of investment that you know, there may well be challenges. That this is not a guaranteed return in any way, shape, or form. So if someone is looking for, if you like, the lowest risk possible when it comes to property investment, then that's where the charges come in and personal guarantees come in. But very often then it's a single digit return, whereas the equity, which ranks after the charges and the debt, as you mentioned, has a higher rate of return, but with that goes the higher risk. And in my experience, you know, investors tend to like a diversification. They perhaps like to have some of their investment money in what they might perceive to be less risk in terms of the structure, but they also want to have some of their funds working at a higher potential ROI. So it's up to every individual what their attitude to risk is, but it certainly equity ranks after the debt and the charges.
Yeah, a real important point on that, folks. It was in the FCA consultation paper that's out right now. Equity involves possible losses of your capital, and it could involve 100% loss of your capital. There is no guarantee. And people who can't afford that shouldn't be involved, or you should very much ring fence, like £100 you would have spent maybe going out to dinner back before COVID, fine. Maybe you can afford £100 and you're going to learn, you're going to put some money at risk. But it's very clear that the risk tolerance has to match what you're doing. And if you can't afford to lose it, then you shouldn't be investing in it.
Thank you, John. So is there an industry average on return on investment for those types of projects?
I would say no, but what's interesting is one of the beauties of transparent markets, so stock exchange, crowdfunding platforms, things like this, is you have what's called price discovery. I used to work in an investment bank. Price discovery is where you look at the past transactions and form a view about what the normal market price is for that activity, that share, whatever. We do this in the housing market by looking at prior sales. And from the other sales, we form a view about what the value is. So if you want to know about industry return on investment, look at comparable projects, similar size or scope, similar duration projects, similar risk profiles, share structure. And if they're offering 10%, 15%, 20%, whatever the number is, and there's a number of those, then possibly that is about the right number for this project. There is no average in the strict sense, and there's no absolute number that is right or wrong. At the same time, you can start to form a view.
Yeah, I'll just add that slightly though. Disagree is probably too strong a word, but putting a different caveat on it, maybe regarding the industry average, you know, what John's saying is correct. But if you take the world of property crowdfunding and you look at all the different sites that do equity, I think you'll find that most fundraisers are offering in around about a 20% per annum ROI for this type of development project. So as a rule of thumb, or as a general ballpark, if you're a fundraiser and you're thinking, what do I need to offer crowd investors to make them look at my project? I would say that around about 20% per annum is probably a good rule of thumb. That might be over a 16, 18, 24-month project, but that just gives you an idea of a ballpark.
We have got a question there. So just on the back of what John stated, how many projects or investments would it take to be classed as a sophisticated investor by the FCA?
Under the current legislation or regulations as they stand now at the time of this recording, you need to have invested in 2 transactions. So these are independent of each other. They're 2 separate share offerings. So if it's equity, you've invested in shares twice. For a company that is not listed on a stock exchange, doesn't have liquidity. So if you're on a particular platform, I would say 2 of those. The presumption isn't that you're, quote, sophisticated in the sense that, man, you know everything. It's more that they feel you've been through the process and you've now achieved enough understanding that you can be classified as sophisticated. It does come with extra risk. That means you might see deals you wouldn't see if you weren't classified as sophisticated, and you need to appreciate that it's on you to make an informed decision. Some people would select restricted retail as their status just to prevent themselves from being tempted to look at deals that possibly they don't understand.
Thank you, John. So just moving on to our planning project types, so different strategies for different developers. The fundraisers raises the cost of the planning application from investors. How does an option agreement work?
An option is the right to buy. It's not the obligation. The party issuing the option, so classically the owner of the property, is saying, I agree to sell it to you at some time in the future as per what we've agreed, and it's written down. I would always have an option agreement written down. And the party receiving the option, they pay for it. They pay money, option consideration. So Dal, if you were selling a property and I agreed to possibly buy it in the future, it is possible. I pay you, say, £100, £1,000, £1, £1 million. And for that exchange of consideration, you agree to keep the property so that if I do want to buy it, I can buy it at whatever terms and conditions we agreed. A lot of times this is done with development because the developer or the business is trying to arrange some other things, whether it's planning permission, whether they're trying to buy the neighbor's lot also, and they don't want to go forward with the project unless those other conditions are met.
Brilliant. Thanks, John. And what happens if the planning application is rejected?
Basically, planning's not awarded. Now, if you're asking what happens to my investment in a planning project, well, classically, that might mean you've lost 100% of your money. In most planning raises, the money is being spent on planning, and if planning fails, that means that you were not successful getting what you wanted. The money's been spent at the council and on consultants, and there's nothing more that can be said. There may be, if you read the offer document closely, there may be some plan B, plan C, plan D about going to appeal, or we'll sell it for what we paid for it, or we'll not use the option, so we're limiting our losses. But truly, in these examples, there is a very strong possibility you'll lose 100% of the money spent on planning and the associated costs.
And following on from a previous comment about risk versus reward, this planning project very much set at the higher end of the risk scale for the reasons that John just mentioned. The acceptance of a planning application is outside the gift of any of the investors, and certainly outside the gift of the fundraiser. It's obviously at the gift of the council, and even when applications seem to tick all the boxes, as those experienced in this property development field will know, that does not mean you're going to guarantee to get an application approved, which can be very frustrating, but that is the nature of risk. So that is why, for instance, on the platform, the projected returns on the projects that we have done in planning, are 40, 50% are projected ROIs. Hence, they're high, but obviously then it comes with risk. So as John said, certainly a good place to invest and learn, understand the process, providing this money that you're able to lose if the worst case scenario happens. But if it comes good, then it's a heck of a return on investment money, which is why these projects do tend to fund quite quickly, because people who understand the nature of risk are still very happy to speculate. I think that's fair to say, John. These do have an appetite because people do understand the risk, but they also see the potential reward.
Yeah, it's definitely speculation. I would actually say a lot of the development projects are speculation. One of the ways to mitigate risk of a single failure is to take your money and divide it across multiple projects that aren't closely connected. So different developer, different location, different planning office or council. If you are the same with development, you don't know when they're going to find an archaeologically significant site that then is delayed for 6 months and has cost overruns. So if you have £1,000 and you invest in 10 deals, the odds of all 10 failing are low. And if they do, it probably says more about your selection criteria than anything else. And if you spread it across 10 deals and one of them is at 50% and you lose 100% of the money, that's £100 lost. If another one is at 20% and you make your 20% return, then it starts to smooth out a bit. And if you did 10 different planning projects and 5 of them failed, but 5 succeeded, you might find, depending on the rates of return, that you're still in profit. You're just not at the maximum. You're at a comfortable level, depending on your tolerances. So do your homework, check out the teams, but at the same time, think about diversifying across a portfolio of these.
Great, thank you, John. And David, so going on to income generating projects. So Becontree, of course, those investors have already had a look. We currently have Becontree live, which we'll go through in just a moment. So property built and rented, investors potentially receive an income from the rent and capital growth. So why are the return on investments being offered usually lower for this type of project?
I would say there's 2 answers. One is the market doesn't require a higher return, that people are comfortable accepting a lower return because the alternatives are also lower. Similar projects, rent and hold, buy and hold, buy and let, single let, these sorts of things. So you compare apples for apples at some level. Another thing is you could argue in pure theory that the risk profile of a buy and hold project, maybe with a bit of remodel, but no planning risk, no development risk, is lower. So the cost of capital, the reward that the investors need to have is lower because they don't expect as much risk, so they don't expect as high a return. You can still have problems. There could be all kinds of things that happen, fire or whatever. So again, you might want to diversify across a few projects rather than putting all your money into one, even if you think it's a lower risk project and the team's got a great track record. Stuff happens all the time.
I think I would answer this question, Dal, by asking a question. Lower compared to what? One of the dangers, I think, in property investment sometimes is people look at apples and pears and try and compare them. So my background initially in property was in the buy-to-let world in Northern Ireland, very much the low end of the market where you're looking to maximize your yield. I used to joke that one of my marketing statements was my nickname was Double Digit Dave because I tried my very best to get properties to net yield at 10%, like the holy grail of getting into double digits. So, the vast majority of properties out there in the rental market don't yield 10%. Whereas if a project on the platform is yielding net 12%, which is what our Becontree Avenue project is doing, you could argue it's actually not lower, it's higher compared to similar types of projects. So again, it just depends how you look at it.
Yeah, I think in London it's something like 4 to 6% yield. That's kind of your average. If there is no liquidity event, how is the capital appreciation calculated?
Okay, so let me define liquidity event. This is where essentially we go from an asset, a building or whatever, turning it into cash, making it liquid, making it sort of easy to transact. It's a term from the financial industry. Essentially, it normally means a sale or refinance or some other opportunity to bring cash in. If there's no cash received, then there's also no real benchmark for the price of the asset. If you're not refinancing, you're not selling a building, how do you know what it's worth? You could get a RICS valuation, but that's technically an opinion. And a RICS valuation that's spot on could be 10% higher or 10% lower, as far as I understand the RICS Red Book. Not an expert, but I believe it's 10% plus or minus. So it is going to be in the shareholder agreement how they would determine value. You also may not be benefiting from all the appreciation. There may be some limits on that. There may be some prioritization when it comes to the rental income or the appreciation, who gets what, when, and who gets priority. So you do need to read the shareholder agreement. But if there's no liquidity event, it'll detail, well, we're going to get two values. We're going to talk to an estate agent. We're going to flip a coin. We're going to go have our palm read or something or whatever, flip cards. It'll be in the document, and that'll determine how the value has been calculated and then what percentage you're going to receive.
Just add one thing. If you do read in the shareholder agreement that the fundraisers intend to have their palm read or look for some cards, then that may not be a project investing, but I know John's point. Yes. Exactly that. It's difficult to determine.
Well, also use the forum. If you are unsure what it means or you don't think it's appropriate, then go to the forum for that particular raise, post the question, let the people involved respond, let the other investors have a view by everybody seeing the same thing.
Thank you. So David, I know that you've been in conversations with Creation Tech. If you want to kind of just highlight the next slide for me and the new projects as well.
Yeah, thanks very much, Dal. I'll just run through these quickly before we wrap up. Good job asking all those questions there. So some fantastic information supplied, particularly by John there, and that'll be very useful, I think, to investors. So the Plough Hill View, the payback on this was slightly delayed just due to the processes of the drawdown of funds from the lending company. So the first part of the payment actually hit the sharing account yesterday. Second part will be today. So we do estimate within about 48 hours, then the investors will have their money back in their e-wallet. So this is a project that is fully completed. I was talking to Hitesh yesterday. He's paying back a 30% ROI, which was what was projected in the equity offer document. So a brilliant project, and you can access this on our site, have a look at it. But those that invested, you should receive your funds within 48 hours. So the Becontree Avenue project that Dal mentioned actually closes tomorrow at 5 p.m. So this was one of these income projects that we just discussed. It's 9 apartments and a commercial ground floor, fully built, fully let. You can see what it was, and then what AJ and his team at PLMD turned it into, complete with nice sort of open top garden on the roof, which I think was particularly useful during COVID. So this is a projected 24% ROI over 24 months. But the exciting part of this is that this is paid quarterly. So it's like a quarterly dividend payment based on the rent. And that comes in every quarter over the 24 months. So the maximum raise is 200,000. It's reached its minimum at the start of the week, which is fantastic. So it's a successful deal. The deal will go ahead. It's currently at 31 investors at £138,200. So there is still room if anyone else wants to invest in that. There are project webinars that you can listen to, some Q&As that AJ and the team did to access the information. And of course, you can draw down or download the equity offer document from the platform. So this closes tomorrow at 5 p.m. It's a successful raise. It's just now moving towards its maximum, and you're welcome to have a look at that if you wish.
What on that raise? What's the minimum investment?
£100.
Okay, so folks, yeah, if you do pledge, you'll then get access to the shareholder agreement when it's released. I want you to read it. I want you to possibly use the forum if you have questions. This is an opportunity to learn, besides possibly earn a positive return if it's a successful project. But you have to form your own view. You have to be able to put money that you expect to possibly lose. There's no guarantees, but it's definitely worth taking a look at the details.
So Aldwick is literally in the final bits of approval. Should be view deal, if not this week, early next week. Mixed use HMO project from Target 5 down in Bognor, Regis, so you can keep an eye out for that. And we're also preparing another raise for Creation Tech, JV partnership, Wates House down in Ferrum. And again, this will be on the platform quite soon. So I was just letting investors know what's coming down the line. So John, do you want to just speak to this briefly in terms of our follow-on from our successful fundraiser bootcamp we did in December?
So David and I ran the first one of these in December. We had a really good 3 days with a number of investors who are looking to raise money. So this is directly targeted to those who are listening that you're looking either now or in the future to raise money. You want to raise equity. This is not about how to raise debt, though we'll cover slightly a little bit about how the debt stacks up. And if you're trying to do this correctly, you're trying to do it legally, and you're trying to attract investors who understand what that means, then do take a look. David will have a URL for you sometime soon. And we'll be doing this as a workshop. You're on camera, we're getting stuff done. You'll have everything you need to know at the end of the 3 days so that you can actually get out there and raise money through a legal process, basically using the platform so that actually it's signed off when it comes to any investor can see it in the UK. And if you're interested, either get in touch with David or I, and we can provide more information, and David will supply a URL in an upcoming message.
Indeed. So if you're a property developer, you're a landlord, someone to refurb property, sort of any reason to raise funds for property investment, then you can absolutely come to this, and you'll definitely find out what you need to know. So Dal, back over to you.
Yeah, so next week's broadcast topics. So we'll be covering just different elements and emergency, affordable and social housing. So that should be a good session for anyone who's looking to get into that space. And we'll outline kind of, and if there are any questions that you want us to mention, feel free to reach out to me directly. You'll have my details or David's details or the support email address in just a moment.
There it is.
There we are. Yes, indeed. So yeah, feel free to reach out via the support channel, either to David or support directly, or Dal at leocrowdfunding.com. I want to thank everyone for attending, and we'll hope to see you next week. And thank you very much, John and David.
Thanks very much. All the best, and good job, Dal. Well done.
Thank
Talk to you all soon. Bye-bye.
Bye.